This is Ed Jorgensen, and welcome to a discussion of inflation. Not the inflation of today, whatever it is, but some memories of the Vietnam era, the 60s and 70s, and our last post-war experience with years of inflation. The coronavirus market has entered uncharted territory in the past several weeks, as the central bank and the administration have dished out trillions of dollars to financial markets, shattered businesses, and destitute workers. The stock market has recovered its winter losses while the general economy is in a Great Depression. Can the government recreate wealth by printing paper money? It seems incredible that we in the United States are asking this question that, decades ago, was reserved for third world fiefdoms we used to mock. But advocates of the modern monetary policy say that this time is different, and that the V recovery in stocks is right. As it happens, the answers from history are not as clear as we might have thought. There is no precedent for what is going on today in America. But let's look at past cases of government printing money and see if we can glean some hints about the future and how we can respond. One remarkable precedent began with the famous guns and butter policy of Lyndon Johnson in the 1960s to shield the public from the true costs of the Vietnam War. For a long time, it worked. The result was month after month of rising stock market prices. Despite casualties in Vietnam and severe social unrest at home, the stock markets, particularly junior growth stocks, just went up and up month after month. That was the famous 1960s go-go market, and much of our investing industry dates from those years. A new mutual fund family named Fidelity featured hot fund manager Gerald Sy, who bought the latest technology stocks, and word of his buying a particular issue would send that stock soaring. The names: Polaroid, Control Data, Teledyne. But the most famous stock of the go-go market was none other than Ross Perot's Electronic Data Systems, which provided computer services to the emerging welfare state set up under President Johnson's Great Society. The initial public offering of EDS stock was as hot as they get, a lasting emblem of the go-go era. That period of printed money boom times ended in 69-70, when the new Republican administration under Richard Nixon tried to tighten up on the easy money. That restraint led to a market crash in 1970 and a recession. So the Republicans abandoned tight money and started their own spending spree. It took a few years for the inflation of the Nixon era to show up in the economy, but it did. By 1971, inflation picked up to 4 to 5%. In response, that Republican president imposed wage and price controls and took the United States off the post-World War II gold standard. Taking the United States off the gold standard marked the beginning of the Republican version of a printed money boom and triggered the second wave of soaring stock prices, this time in blue-chip growth stocks called the Nifty 50. Companies so nifty that you could buy their stock at any price and be confident the stock price would continue going up. The most famous was, of course, IBM. The Nifty 50 boom was in the growth leaders of the day, not in small cap speculative stocks, so most investors believed and bought in. And for month after month, the Nifty 50 rally in market leaders just went on and on. Indeed, it never crashed on its own. The Nifty 50 rally didn't end until the Arab oil embargo. Angry that the dollar had weakened after the U.S. left the gold standard, Arab oil exporters, OPEC, imposed an embargo. Oil prices shot up. President Nixon raised interest rates to limit the inflation, and the Nifty 50 market collapsed in the greatest bear market since the 1930s. Both the go-go rally in speculative stocks and the Nifty 50 rally in growth leaders proved tricky for investors. Let's look at the go-go rally first. The speculative stocks, of course, did better in this early inflationary bubble rally, gaining roughly 50% versus 25% for the more conservative stocks. But both suffered severely in the ensuing bear market. Speculative stocks lost 55% and old line stocks lost 30%. Investors trying to be cautious simply made less going up and lost less going down, essentially a portfolio wash. The Nifty 50 rally holds its own warnings. In the blue chip growth rally, the large cap growth stocks rose 50%, while the broad market rose 30%. Then, in the decline, the growth stocks fell 45% and the broad market fell 60%. So the Nifty 50 fell less, but that was no consolation to investors who were decimated. Here's a summary of the 17-year inflation era market. The inflation era market included the Vietnam War, end of the gold standard, the go-go stocks, the Nifty 50 stocks, the oil embargo, the recovery from the embargo, the stagflation of the 70s, and the VUCA era of high interest rates. So what are the lessons from the inflation of the Vietnam era? First, stock markets loved the inflation, with some of the great bull markets of all time, both in small caps and large caps, ignited by easy money. Next, both political parties tolerated the inflation and thought they could patch over it. And the Federal Reserve Board acquiesced. The Fed was led by two legendary conservative bankers, William McChesney Martin and Arthur Burns. Both talked restraint. Both ultimately accommodated inflation. And as for investors, they had to navigate multiple rallies of 2+ years. Stock leaders were the growth and technology stocks of their day, the Polaroids, IBMs, electronic data systems, etc. Rallies ended only by rising interest rates, not because stocks were too high or the rally was ahead of itself. Market corrections were severe. And over the 17-year span of the inflation era markets, ultimately canceled out all rallies. But each 2-year rally was extraordinary, marked by the irresistible momentum of the leaders of the rally. Caution. We have no precedent in America for market rallies where the Federal Reserve Board persists in keeping interest rates at or near 0%. But we have to deal with the future. Well, what lies ahead for us? I believe we are in an era of easy money not seen in the United States in the post-World War II years. I also believe that our Vietnam War experience with massive government spending is indeed a warning to us. But we simply do not know if that past will be a precedent. Our past inflationary era never witnessed 0% interest rates. We do know that in inflationary eras, momentum investing in growth stocks is the most profitable strategy and also the most dangerous. Well, that's a look back at the inflationary 60s and 70s. Those were interesting times. So were these. At the very least, the next few years are going to be, again, interesting. we'll do our best to cope and do well in this environment that really we have a hint of, but we've never quite seen before. Regards, Ed Jurgens.